In partnership, we'll be now dealing with the amalgamation of two partnerships or two sole trade companies concerns into one new partnership firm, like sale of a partnership company, a firm, to some other firms, or conversion of a partnership firm into company. These are the angles we are going to study here. In case of amalgamation, say A and Co, a sole trade business, B and Co, another sole trade company business, both are joined and formed a new partnership firm AB. So these two existing sole trade concerns are closed and new partnership firm in the name of AB and Co will function. And for all the assets and liabilities taken over from these companies by this company, okay, payment will be given to them as a consideration. So assets and liabilities of these partnership means individual firms, individual entities, assets and liabilities transferred to AB. Rather than it may be A and Co and B and Co, it may be A partnership firm and B partnership firm. Here we may have X and Y being the partners. Here we may have I and J being the partners. These two partnership firms are merged and formed a new partnership firm named A and B. These two will fall under amalgamation. These two will fall under amalgamation. Two or more sole proprietors or firms form a new partnership firm is called amalgamation. So one of the leading firm, A and Co, it's a partnership firm, can take over another partnership firm. So B and Co is a partnership firm, A and Co is also a partnership firm. A and Co takes over the assets and liabilities of B and Co. For that, purchase consideration is paid, and later on the B and Co is closed completely. One of the existing company will function thereafter also. This B and Co may be sole trade business or partnership firm. Maybe sole trade or partnership firm. This will be called as absorption. This will be called as absorption. Clear? And understand that A and Co, and here we have a company, XYZ Limited Company, XYZ Limited Company. This A and Co is totally sold its assets and liabilities to XYZ Private Limited Company. Further, the payment will be done by XYZ Limited, Private Limited Company or Public Limited Company to A company in the form of share capital or some other mode. This is called sale to a company. Sale to a company. And finally, we have conversion. A and Co is a firm. Now they formed A Limited Company, and all the assets and liabilities of A and Co becomes the assets and liabilities of A Limited Company. For that, the purchase consideration may be in the form of equity share capital. Earlier, they were the partners holding the capital in the partnership firm. Now they will be also being a shareholders and holding the shares of A Limited. Okay, once this one is completed, this A and Co and firm is closed, and this new A Limited Company will exist. This is called conversion. This is called conversion. So these are the four varieties we can expect in case of amalgamation, sale, and conversion. Okay, but for the examination point of view, this may be pretty rare only. But suppose sometimes once in 4 years they may expect questions. They may ask the questions from this topic also. It's better to know this. In practical life, there is no possibilities of amalgamation of firms, but there may be chances of conversion of partnership firm into the LLP. That may also be possible in practical life. Okay. At your final level, you will study the amalgamation, absorption, and all for the companies. Two companies are merged to form a new company. But all those things are as per the latest NDAs you have to study at your final CFR paper, not here. So here, the basic idea will study about conversion, amalgamation, and sale to a company and conversion related to the sole trade as well as partnership firm. Sole trade or partnership firm. Hope you'll be now able to understand types of practical problems. So we have amalgamation, absorption, sale to a company, and conversion. Now, three predominant points to be followed here. What are they? What are they? So here this company is closed. This partnership firm is closed once it is sold off. From this, they're very clear. There may be closure of one of the entities, either one entity or more than one entity. In case of amalgamation, at least two entities may be closed. More than two entities may also be closed to form one new entity possible. So from this, it is very clear, closure is there mandatory. Here at least two firms or two sole trade entities are closed. Here one are closed. Is that clear? How can we close the entity, sir? You have studied that in your realization account. By preparing the realization account, dissolution chapter you studied. It means you are going to dissolve all this entity. So dissolution is nothing but closing the books of accounts. Here, closing the books of the transferred entity. So for closure, what you have to do? You have to open the ledgers like realization account, and then partners capital account, and then cash account to close. Then we don't have the balance sheet. You remember the dissolution and apply that same dissolution concept here. The step number 2 is over. Step number 2 is over. But in case of dissolution, you sell all the assets and liabilities. You sell all the assets independently. By selling each and every assets, you will realize the money, and the amount you have can be used for paying the liabilities one after one. Is that clear? But in case of piecemeal distribution, you sell one asset by one as and when it is possible to sell, and when recovered is used for settling the external debt and internal debt and partners' capital. That's called piecemeal distribution. But in case of amalgamation, sale and conversion, all the assets and liabilities given and a single short payment is received. You are not going to value all the assets and liabilities independently. Collectively, you will fix a value for transferring all of your assets and liabilities. That can be calculated as a first step, which is called calculation of purchase consideration. Step number 1. Step number 1 is the calculation of purchase consideration. What is the value we offer? See here, value offered, value offered, value offered, value offered by way of equity share capital. So finding the value at which that company's assets and liabilities are going to be taken over is the first step, which is called purchase consideration. Once I offer the purchase consideration, thereafter the assets and liabilities of the company is transferred to me. Then that sole trade entity or partnership firm is going to be closed or dissolved. Follow the dissolution steps here. Slight difference is there between the normal dissolution and the dissolution in the case of amalgamation, where each and every assets are sold and cash is realized. Using the cash, you will settle the liabilities one by one. But here, collectively for all the assets and liabilities put together, you collect only one payment, which is called purchase consideration. Is that okay? And sometimes some assets and liabilities may not be accepted by the buyer. So transferee says, I don't want to take these assets and liabilities, you just close it off yourself. Then that assets and liabilities may be sold by the existing owner to the outside, or may be taken by some of the owners, some of the partners, and some of the liabilities also be settled out of the agreement made by these two entities. Okay. Now, third step is all about, in the books of buyer, transferee, you have to pass the journal entry for taking over all the assets and liabilities, step number 1. And third step consisted of one more component, which is called preparation of the balance sheet after the amalgamation. So these are the 3 steps you need to understand. Most probably in your examination, you may be asked to pass the entry and prepare the balance sheet in the books of transferee. That's how the question may be asked. Okay, very rare to have all the 3 steps to be incorporated in your examination. So it's better have the complete view of all the 3 steps for an illustration. Once it is okay, then what you can do, whatever the questions asked in the examination, you can directly answer, whether it's only dissolution of the transferor company, or incorporation of the journal entry in the books of the transferee company, or preparation of the balance sheet, or just calculation of purchase consideration. Is that okay? Understand all the steps. And closure of books also possible. Either it may be directly by way of a ledger you can close, or you pass the journal entry and close. You have to remember these 2. Now, how can we calculate the purchase considerations? Step number 1. The purchase consideration can be calculated of one of the three methods. One is the transferee company says that I may pay you 1 crore rupees, give your business completely to me. Don't ask me what is the value for each and every assets independently. Collectively, I offer you 1 crore, you transfer the assets and liabilities, that business to me. This is called lump sum consideration. Another method, no sir, I don't accept for that. Then value each and every assets based on today's worth completely. Find out the liabilities payable from the assets, subtract the liabilities payable. So balance will be the company's worth. That's how we can calculate. That is called net asset method. Second method, net asset method. Assets at realizable value and liabilities at payable value. The difference between these two is the purchase consideration. And the third method is the buyer, transferee says, I'll take up all of your assets and liabilities for 1 lakh rupees capital in our business and 5 lakhs cash. I will give 3 lakhs worth of debenture in our company or 2 lakhs debt like in our company. Lots of consideration form may be offered to the transferor. Give her all assets and liabilities, take 5 crore rupees cash. And you become one of the partners in our company to the extent of 1 crore. And you can have 2 crore rupees as my debt. Okay, you are given the debt like various forms offered for assets and liabilities. If the transferor accepts, the summation of all these forms will be the purchase consideration. Net payment method. I offer you equal shares in our business, preference shares, cash, or any other contribution I give to you to come to our business will be net payment method. So we have 3 methods. So purchase consideration can be calculated one of the 3 methods. One is lump sum method, another one is net asset method, another one is net payment method. Clear? So lump sum method, purchase consideration is nothing but which is equal to the lump sum value given. Net asset method is nothing but assets at realizable value, liabilities at payables value. The difference between these two will be the purchase consideration. Number 3. The transferor gets these benefits from the transferee: equity shares in the transferee company, preference shares, cash, even debentures, etc. And all the benefits the transferor gets from the transferee will be purchase consideration here. Clear? Now, we'll go for the step number 2. Step number 2. Okay. In step number 2, it's similar to dissolution. What will you do? 4 steps are there. Step number 1, open the ledger. Step number 2, record the balance sheet items. Step number 3, incorporate the adjustments. Open the ledger. Open the ledger. And record the balance sheet items. Record the balance sheet items. Step 2, incorporate the adjustment. In adjustments, usually will be given what? The sale value of various assets and settlement value for the liabilities and all. But here all the assets and liabilities will be taken by the transferee company for a single consideration. So you have to incorporate purchase consideration. Not only that, sometimes some of the assets and liabilities will not be accepted by the transferee, and that will be separately dealt, not taken by the transferee, not taken. And we need to incorporate the realization expenses. These things are given in the adjustments, we have to incorporate these. And 4th step is nothing but close the ledgers. Close the ledger, okay. Hope now we'll be able to understand 4 points. Closing the books of transferor company, open ledger, realization, purchase consideration, purchasing entity, capital account. While opening the ledger account, realization account, capital account predominantly you open, and you open the bank account also usually. But in case of amalgamation nature, you need to open a new account called purchase consideration. Okay, the purchase consideration is the overall amount payable for the assets and liabilities taken over, and that amount will be payable by the entity, purchasing entity. That ledger account also be opened here. Okay, these are the two additional ledger you have to open. See here, in your realization account, purchase consideration account, purchasing entity account, capital account. Assets are recorded at the book value in the debit side of the realization account. Liabilities are recorded at the book value in the credit side of the realization account. Partners capital account will be transferable to the partners capital account, which is prepared in columnar form, reserve fund. Okay, reserve fund and all. Step number 1, record the balance sheet item. Record the balance sheet item once. Okay, the next step is all about, see, assets recorded, liabilities recorded, partners capital and reserves and surplus transferred. Step number 1 is over. Step number 2, for taking up the assets and liabilities, purchasing company will pay me a consideration. It's called purchase consideration. Usually you sell the asset one by one, so you put the value here, bank and land, building, plant and machinery. That's how you record in case of normal dissolution. But under the amalgamation cases, all the assets and liabilities put together, single payment is given. No, I name this being purchase consideration. Hope will be now able to understand. Transfer here, a realization. This consideration is payable by whom? Transferring company. That is called purchasing entity. So here, transfer there. This is the due entry. Purchase consideration. The purchasing entity will settle this. Either it may be cash or some capital in their own partnership firm or in their own capital, means private company or public company. Or sometimes it may be preference shares or debentures like. So, cash, capital, and capital may be equity share or preference share depending upon the nature, and some portion may be considered as loan. That's how the payment is made. The payable purchase consideration may be settled, either it may be cash alone or cash with some other assets also. The amount paid by the purchasing entity is going to be given to whom? Partners capital account. So partners say, I invested 100 lakhs rupees, sir. Reserve fund 50 lakhs, sir. Realization profit and loss also 50 lakhs. So 200 crores, sir. No worry. You'll get the cash, capital and the loan from purchasing entity. Finally, if I close this, then automatically it is closed. You understand? So if you tally, then you'll get the profit and loss transferable to the capital account. This is transferable to the capital account. Record the balance sheet items once. Assets, post that in the debit side of realization account at book value. Liabilities, post that in the credit side of the realization account at book value. Capital and reserve surplus will be transferred to the capital account. Clear? Step number 2 is over. Now, step number 3 is all about incorporate the adjustments, where first entry being the money payable for the or due for the assets and liabilities, purchase consideration to realization. This amount is payable by the purchasing entity, so due entry is passed, and this due entry is settled. This purchasing entity may pay this by way of either bank or loan or some other form, and this amount is distributed to the partners of the selling company. Is that okay? So these are the 4 steps. Step number 1, first amount payable to the realization. Step number 2, and this is payable by purchasing entity. So due, like first amount payable for the assets and liabilities, next due payable by the purchasing entity. Step number 3, the purchasing entity settles the purchase consideration by offering this way. 4th entry being the offer will be taken by the partners for their respective capital. The 4 steps will be involving here for incorporating the purchase consideration. Is that clear? Hope you will be now able to understand. Apart from that, you have to understand some of the assets and liabilities not taken by the purchasing company. You have to incorporate those things also. How can we incorporate, sir? In case of assets and liabilities not taken over, normal dissolution procedure you can follow. the assets may be sold off and cash realized. That cash can be used for paying some of the partners due. So if bank is needed, you can open that. So some of the assets may not be taken. So then you sell this and collect the cash and keep this in the bank account. And that can be used for settling the liabilities not taken over, or still if you have surplus bank, and it can be used for paying any of the partners amount due. Okay. Apart from that, there may be realization expenses. Realization expenses. Already told you, no. So what are things are there? Okay. Some of the assets and liabilities may not be taken over, and realization expenses to be incorporated. Clear? So these are the steps you have to follow for incorporating purchase consideration. Now, step number 4. Step number 1, open ledger. Step number 2, record the balance sheet items. Step number 3, incorporate the purchase consideration. Try to adjust for the assets and liabilities taken over, not taken over. In the case of realization expenses, that can also be debited to the realization P&L, realization account debit side. Finally, close the ledger. Company closed, and finally, partners' capital accounts closed. And if needed, you can open the bank account also and try to close that one also, right? So these are the 4 steps are involving in the second step. Even you may be asked to pass the journal entries, then you can pass the journal entries this way. For this assets 1 entry, realization to asset, liabilities 2nd entry, liabilities to realization, and 3rd entry is nothing but purchase consideration, 3rd entry, and reserves and surplus here. This is the 3rd entry, reserve surplus to capital. Apart from that, incorporation, these things 1, 2, 3, 4, these 4 entries will also be passed. 1, 2, 3, 4. Okay, these 4 entries, and you may need to pass entries for the special adjustments also. Now, in the books of transferee company, we have to now pass the adjustment entry as well as prepare the balance sheet. Okay. 3rd step. What is the 3rd step here? Pass journal entries and prepare the balance sheet of transferee entity after the amalgamation. Now, if you are purchasing any item, what is journal entry? Purchases to creditor. Here also we are purchasing not one item, it's complete business. So name this being the business purchase to the creditor being the partners of that company. Who are the creditors here? Partners are owner of the selling company. So business purchase account debit to partners of selling company. And next one is business purchase as it is cannot be recorded anywhere in our balance sheet, because business purchase consisted of various assets and liabilities. Now I'm replacing the business purchases with the assets and liabilities taken over. Now debit all the assets, credit all the liabilities. Debit all the assets and credit the liabilities. So first entry being business purchase account debit to partners of selling company, partners of selling entity. And now this business purchase is cancelled by transferring that to assets account debit to liabilities to business purchase. Remember, assets are recorded at NRV value, realizable value. Liabilities also net payable value, and business purchase is the value. If you find any difference between the debit and credit, either you may pay more than its worth or less than its worth. If you pay more than its worth, then that's loss named as goodwill. If you pay less than its worth, then it's a gain named as capital reserve or reserves and surplus, simply reserves and surplus. You can get one of these two as per the scenario you have. Is that okay? Second entry. Clear? Now, third one is settlement to the partners of selling company. What you are going to offer? Partners of selling company. What you are going to selling entity? What you are going to offer? Either it may be simply cash, or ask them also to join with us in our company, being one of the partners. Then they will be eligible for the capital in our company, capital of our company. Okay, capital of the owners of the selling company becomes the owner of the purchasing company. May also be possible. Clear? These are the 3 entries. Finally, you can prepare the balance sheet after incorporating the items given in this journal entry with respect to their existing balance sheet to get it closed. Only 3 steps we have. What are the 3 steps we have here? Step number 1, purchase consideration calculation. Step number 2, close the books of transferor entity. This is similar to dissolution only. Okay. But new item being purchase consideration and purchasing entity will come. Okay. And past journal entry. 3 journal entries are there. One is business purchase entry. Next one is converting the business purchase into the various assets and liabilities to be incorporated in our books. Third one is due payable, settlement to the owners of the transferor company. Finally, these journal entries are incorporated with the balance sheet of the amalgamated or transferee company. Is that okay? Most probably in your examination, you may be asked these two or these two. Okay. You are not supposed to answer for all the 3 steps. Clear? Shall I start with one illustration now? Yes. A and B carry an independent business in provisions and their positions. A is also a sole trade entity, B is also a sole trade entity. Right. Both of them want to form a partnership firm on 1/1/24 on the following understanding. The capital of the partnership firm, probably we assume a new firm is started. I name this being A, B and Co. The overall capital of this entity being 3 lakhs. Which would be contributed by them in the ratio of 2:1. So A contributes 2 share and B contributes 1 share. So automatically what happens? The assets and liabilities of A and B becomes the assets and liabilities of A, B and Co. For that A, B and Co will offer purchase consideration. The purchase consideration being only capital, 2 lakhs for A and 1 lakh is for B. The mode of payment is 2 lakhs capital in A, B and Co for A and 1 lakh capital in A, B for B. Okay, they are not offering in the form of cash or some other form. The partners, the owners of A entity becomes the partner in AB, and all the assets and liabilities given by A will becomes the capital for his own contribution in the new entity. Clear? The assets of the individual business would be evaluated by C, at which values the firm will take them over, and the value would be adjusted against the contribution due by A and B. Whatever the value of assets and liabilities shown in their respective balance sheet is not reliable. So we have to find out what is the today's worth and find out those value. At that value, it is going to be taken over by A and AB. And the assets taken over at the revised value, no, that is considered as a part of their own capital. Part of their capital. It's not full capital. Because A is offered 2 lakhs rupees. If the assets taken over from A being worth 1,80,000 rupees, 20,000 further he has to invest. If it is worth 2,20,000 rupees, 20,000 may be returned. C gave his valuation report as follows. C gave the valuation report. Okay. Let's see. I may mark down that. This is the value at which is going to be taken over. Assets of A. Stock in trade to be written down by 15%. And a portion of sundry debtors amounting to rupees 9,000 estimated unrealizable, assumed by the firm, not to be assumed by the firm. So firm says, I cannot take the debtors worth rupees 9,000. They are not able to pay. He is not in the position of paying. Okay, so I don't take. You collect from him yourself. Furniture and fixtures to be valued rupees 2,000. 750 is reduced. And investments to be taken at market value 1,000 rupees. 487 is added, 1,000 rupees. Assets of B, Stock to be written up by 10%. Here 10% is added. Sundry debtors to be admitted only 85%. Only 85%. Balance 15% being the loss. Rest of the assets to be assumed at their book value. At their book value. Is that clear? Now, the firm is not to assume any creditors other than the dues on account of purchases made. So, creditors due to the purchases made is taken by the transferee company, entity, others not taken. So, bills payable accepted, creditors for expenses not accepted, trade creditors accepted. Okay, creditors for expenses is nothing but rent payable or outstanding like. So, that you have to settle, no way to commit by the transferee entity. So, it's our responsibility to settle this. Now, you are required to pass journal entry in the books of A and B. Also prepare opening balance sheet. So only these things are asked. As I already told you, you are not supposed to prepare all the things. Here only journal entry as well as balance sheet. A comprehensive illustration covers what? Purchase consideration calculation in detail, passing journal entry and closing the ledgers, and then passing the 3 journal entries in the books of transferee entity, and then preparing the balance sheet. That's what about the comprehensive one. But in your examination, you are not supposed to prepare all these things, because during the time constraint, you can finish off only selected part. So you have to answer only the questions asked here. Okay. Now, let me find out the purchase consideration here. Calculation of purchase consideration. Purchase consideration for entity A as well as for B. All the assets and liabilities are taken at the accepted value, valued by C. Stock 1,70,000. 15% is reduced and taken. What is the value? Come on, tell me. $1,44,500. 98,000 plus 10%, 9,800 should be addable. So 1,07,800. Debtors 9,000 is subtracted, taken at only 80,000 rupees. And 37,000 into 85%, 31,450 at this value it is taken. Bank balance as it is taken, 7,500. Cash taken as it is, 987, 234. Furniture and fixtures, 2,750 minus 750, taken at 2,000 rupees. Here 1,766. And investment taken at 1,000 rupees dash here. What is the total of assets value? 2,41,487, 1,48,750. 2 liabilities are taken over. One is creditors, another one is bills payable. Means payables due to the sale of the items. They are trade creditors and bills payable. So we'll take that one. So 1,10,000. Here being 47,000. Bills payable 12,500 and dash. Now the total liabilities payable being 1 lakh 1,22,500. Okay. Net value being net asset. Net assets being 1,18,000. $987. For B, 47,000 should be subtracted. Final value being 1,01,750. In the partnership firm, their new P&L ratio being 2:1 and the capital in the partnership firm being 3 lakhs, okay, offered to them in their own P&L ratio. 2 lakhs for A, 1 lakhs is for B. See here, the assets and liabilities of A worth rupees 1,18,000 but offered 2 lakhs worth of capital. What does it mean? A has to deposit further amount to make it equivalent to his own capital contribution. How much he has to deposit? 81,013 he has to bring in. For him, only 1 lakh worth of the asset is more than that, so we can refund 1,750. Okay, refund. So we found out the purchase consideration being net assets, but capital contributed in their partnership firm being 2 lakhs and 1 lakh. Shortage or surplus is settled off by making the payment or releasing the payment or collecting the money. Okay, bank. Step number 1 is over. We'll move on to the step number 2. What's that? Close the ledgers. Close the ledger. So, how do I close now? Open the concerned ledgers and partners' capital should be in columnar form. Partners' capital should be in columnar form. I prepare completely in columnar form. Because seller being only one owner is there. Now, realization account, purchase consideration account, and AB purchase consideration and AB Limited and Co. and then capital account. So I post the book values. The assets and liabilities appearing in the books will be closed. Okay. Yes. This one is for A and this one is for B. A and B. Record the balance sheet items at its own which value? Book value. We are closing. As we are closing, we have to reverse the value available in the books. Stock. To and by. That you can write in your examination simply once. Stock 1,70,000 shown at the book value because we are closing the value available in the books 170,98. But while valuing, we have to take only the realized value. Debtors 89,000, 37,000. Bank also be taken over by the purchasing entity. If it is not taken over, then you can open separate account 13,000 and 7,500. Cash 987, 234. Furniture and fixtures F&F 2750, 1766. Investments 513, 513 and dash, 513 and dash. He posted the assets in liabilities, trade creditors 1,10,000, 47,000. Creditors for expenses 750 and 2,000. But this one is not taken over. Not taken over. As it is not taken over, it should be transferable directly to the capital account. It's their responsibility to settle out of their own fund, personal fund. And bills payable 12,500. Capital 1,53,000, 1,53,000, 95,500. Okay. So what I have done, I close the balance sheet items. I am going to incorporate the purchase consideration. Purchase consideration payable to A being 2 lakhs, B being 1 lakh. B being 1 lakh. Is that okay? Otherwise, you can take the NAV, the amount will be privately collected. That way also you can work out. What is the net assets value of A and B? This value. Purchase consideration being 1,18,987, 1,01,750. That's how you can show in either way. Okay. So automatically it becomes a part of the amount payable by the transferee entity. Later on, the difference is personally recovered or repayable. It is going to be passed only in the books of transferee entity. No need to show here. No need to show here. This will be transferable to here, realization account 1,18,987, 1,01,750. Payable by whom? AB Limited 1,18,987, 1,01,750. So here purchase consideration payable by AB Limited. So 1,18,987, 1,01,750. How the settlement is made? This is nothing but capital in AB. 1,18,987, 1,01,750. Okay. So this capital will be offered to the respective existing owners. So here A will get capital in AB. This is the balance in the respective entity. Now they will be getting capital in transferee entity 1,18,987, 1,01,750. Is that okay? Now this one is not taken over. As it is not taken over, it's the responsibility of the concerned head or owner to settle out of their own personal money. Personal money means capital account. So I transfer directly here, realization account for sundry creditors. How much is that? 750. Usually sundry creditors means expenses creditors. 750 and 2,000. Now close the ledger to find out if there is any profit or loss. These are simply closed. There will not be any balance here. Now you have to finish off sharing the realization account. A has a loss, I think, 2,77,000. 2,77,000. Loss is there, transfer up to the capital account. 34,000. 763. For B, there is a gain 1,50,750. 1,50,750. The gain is transferable to the partner's capital account, the value being 4,250. The creditors should be transferable. Sorry, I made a mistake. Opposite side you have to post. No, I made a mistake. And transfer to the partner's capital account, realization account for creditors payment, sundry creditors, 750 as well as 2000. Now, in case of A, there is a loss charged to their capital account, realization loss. This value being 34,763, and for B, there's a gain. So I'll post this value here. Realization profit. Hope this will also be getting closed. 1,53,750, 1,01,750, 1,53,750, 1,01,750. Now, I skip posting the journal entry or passing the journal entry, but I guide you here. Journal entry number 1 for assets. Journal entry number 2 for liabilities. Journal entry number 3, the assets and liabilities not taken over. Then 4 being purchase, the mode of payment. 7 being this mode of payment is taken over by the existing partners. And result transferable to the partners capital. So these are the 8 entries you can pass easily. Clear? Assets, liabilities, and assets and liabilities not taken over is transferred with the partners capital account. And then for purchase consideration, we have 4 entries. First entry related to the realization, second entry is the due payable from AB, and third being the settlement in the form of capital, and that capital is taken over with the partners capital account. Such a way we can pass entry here. Now, I am going to pass a journal entry in the books of purchasing company. I'll take this one here. If it is clear, message me so that I will move on to the next one. You can pass the entry yourself. Let's see. Business purchase account debit. Business purchase account debit. To amount payable to whom? A as well as B. I can consider this being capital directly. B is capital. The amount payable to A being 1,18,987. Anyhow, that payment is going to be the capital of the company only, no, in the partnership firm. So in partnership firm, it is named as capital only. For B, 1,01,750. The value paid for purchasing the business in this case being 2,20,737. Now, this business purchase is replaced with assets and liabilities. What are the assets we have? Stock account debit, debtors account debit. Come on, it's better to sum up and get me the value. 2,52,300. Debtors 1,11,450. Bank debit 20,500. Cash 1,021. Furniture and fixtures 3,766. Investments 1,000 rupees. 2 creditors for purchases 1,57,000. And 2 bills payable 12,500 and 2 business purchase. Okay. Under net assets method, you don't have the goodwill or capital, so it will be automatically tallied. 2,20,737. Now, we want to ask A to contribute further, so the entry being bank account debit to A's capital. We offered 2 lakhs rupees worth of capital to A, but his assets and liabilities worth rupees only 1,18,000. The shortage is now brought in by him in the form of cash, 81,013. 81,013. And for B, there is an excess amount will be paid off. So B's capital account debit to bank. This value being 1,750. Hope you will be now able to understand this one. Now you can prepare the balance sheet easily. Balance sheet of AB. Business purchase debit, credit got eliminated. Now assets. I write all the assets here. Stock 2,52,300. Debtors 1,11,450. Bank 20,500. Cash 1,221. Furniture fixtures 3,766. Investment 1,000. I make a slight corrections with bank. 2,500 added with 81,013, subtract 1,750 negative value. Find out the ultimate bank balance. 99,763. And creditors and bills payable 1,57,000 and 12,500. Capital under that A and B This value and this value together it comes 2 lakhs. This value minus this value comes 1 lakh. The firm's capital being 3 lakhs now, as they expect. The total of balance sheet after the amalgamation being 4,69,500. 4,69,500. In this question, they have not asked this journal entry. You need to prepare the balance sheet directly. If you want to prepare the balance sheet directly, what you can do? This purchase consideration you have worked, no. This is okay. We directly add up and post this in the balance sheet. You no need to pass a journal entry also. In your examination, whatever the content asked for answering should be answered, not all other things. Okay? Come on, make a note of it. Shall we move on to the next one? Text me, online students. Make it faster. Next illustration is all about amalgamation of firms. So we started with the two sole trade entities amalgamated to form a partnership firm. Here, two partnership firms are amalgamated to form one new partnership firm. Right. Firm X and Co consisted of partners A and B sharing profits and losses in the ratio of 3:2. Firm Y and Co consisted of partners B and C. From this, it is very clear B being the common partner in both the entity. In Y and Co, B and C sharing profits or losses in the ratio of 5:3. It was decided to amalgamate both the firms and form a new XYZ entity, wherein A, B, and C would be the partners sharing profits and losses in the ratio of 4:5:1. Balance sheet is there. The following were the terms of amalgamation: goodwill of the entity X and Co being 75,000, goodwill of Y and Co being 40,000 rupees. Goodwill account not to be opened in the books of the new firm but adjusted through capital account. Usually we will not open the goodwill account. We adjust the ultimate impact of the goodwill to the partner's capital account only. The same it is given here. So the first point is all about adjustment for the goodwill. Building and machinery vehicles to be taken at this value. So second and third are the revaluation of assets and liabilities. Okay, second and third. Okay, building and machinery vehicle are to be taken at 2 lakhs. building 2 lakhs, machinery 1 lakh, vehicle 74,000. Provision for doubtful debts to be created 5,000 and 4,000 are to be provided. Okay, the limited adjustments are there. Show how the goodwill value be adjusted amongst the partners. The first predominant requirement is this one. Prepare balance sheet of XY and Co. as at 31st March 2024 by keeping partners' capital in their profit sharing ratio by taking capital of B as a base. The excess or deficiency be kept in respective partners' current account. That's a very simple question. You have to prepare your notes for adjusting the goodwill. Second, directly prepare the balance sheet. You no need to prepare the purchase consideration and close the books of accounts and pass the journal entry in the books of incorporation and preparation of new balance sheet. Directly you have to prepare the balance sheet. Now, let me finish up the goodwill treatment. Goodwill treatment. Okay. How? This details is there. What is the P&L ratio? 3:2, 5:3. The new entity 4:5:1. Whose capital will be taken as a base? B's capital should be taken as a base. Come on. How do you adjust for the goodwill? Raise the goodwill and cancel the goodwill. Raise the goodwill and cancel the goodwill. Raise the goodwill to the old partners in the old ratio. Who are the partners? A, B, and C are the partners. A, B, and C are the partners. While raising the goodwill, goodwill related to X and Co. will be raised to the partners in the X and Co. in their old ratio, 3:2. The 75,000 should be raised to these two. A, B, C. Yes. 45,000 and 30,000. Hope this value is correct. I am sharing this 75,000 in the ratio of 3:2. So 45,000 for A and 30,000 for B. Similarly, raise the goodwill for Y. Y goodwill will be raised in their respective capital P&L ratio 5:3. The value being 40 should be raised between B and C in 5:3 ratio 25,000 and 15,000. Rising will be nothing but crediting in their capital account. Now cancel the goodwill to all partners in new ratio. Okay. New ratio means for the new entity, new ratio being 4:5:1. Don't cancel separately. You can cancel both put together collectively. 1,15,000. 1,15,000 will be cancelled using 4:5:1 ratio. Come on, tell me. 46,000. 57,500. 11,500. 11,500. Now, what about the ultimate value? For A, 1,000 should be debited. While cancelling, it should be debited. So, 1,000 debit for A. Here, 2,500. 2,500 debit. Here, 3,500 credit. Hope now you'll be able to understand the adjustments for goodwill. First question is over. Now, I have to prepare the balance sheet. While preparing the balance sheet, I need to know what's the value they have, right? What's the value they have? Partners capital. You can simply calculate prepare the capital account easily. That means the new balance sheet easily. It's quite a bit easy. Now, balance sheet of XY and Co. XY and Co. Assets, cash 70,000, debtors 60 plus 80, 140 minus PDD 9,000, 1,31,000. Always remember, if there is any PDD to be created, you have to maintain that to be subtracted from the inner column. In the earlier illustration, I have not considered the PDD because one of the debtors from whom the collection is tougher, so transferee concern says I don't take it. I don't take it. So then I just forgot this to be shown, not required to be shown here. Sundry debtors amounting to rupees 9,000 estimated unrealizable not to be assumed. It is not PDD. If it is being the PDD, take full value and show this being the PDD subtracted in the inner column. Here it is a PDD. Now stock. How much? 70. Vehicles 74,000. Machinery 1 lakh. Building 2 lakhs. Capital A, B, C you have to calculate. Creditors 1,20,000 plus 55, 1,75,000. Now, what is the balance of these three partners' capital account? What about the balance of these three partners' capital account? Imagine how you can find out the closing balance of these partners' capital account by preparing the capital account only. You are not going to prepare the capital account because it's not asked. If you prepare the capital account, of course, you can get the answer comfortably. But don't want to waste your time for preparing the capital account. Not asked. You can prepare a statement for the capital account to find out what is the capital have. They have the balance. Okay, capital balance they have. Now, in X and Co. and in Y and Co. who are the partners? In X and Co, A and B are the partners. In Y and Co, B and C are the partners. Start with capital balance they have. How much? 150 and 1 lakh. If you prepare the capital account in X and Co, what the balance you will have for A and B should be identified here. 1,50,000, 1,50,000 and 1 lakh. If you prepare the capital account for Y account, 75 and 50,000 rupees for B and C. Reserves. The reserves of X and Co will be shared between X and Co in their respective P&L ratio 3:2 and 5:3. 3:2, 5:3. 30,000 and 20,000. And here 40,000 should be shared in the ratio of 5:3. 5:3. 25,000 and 15,000. What happens for the revaluation case? 20,000 loss 80,000 gain, 5,000 loss. Ultimately, 75,000 is the revaluation profit or loss. Revaluation profit or loss. Am I right? 75,000 gain in X and Co will be shared between X and Co in the ratio of 3:2. You will get what? 45,000. Isn't it? 45,000 and 30,000. In case of Y and Co, 14,000 loss, sir, 4,000. Here 16,000 loss. Both are loss, being 20,000 in total loss. This will be shared between Y and Co, means the partners of Y and Co in the ratio of 5:3. 12,500 for B, 7,500 for C. Okay. No, here the loss gain is how much? Only 50,000, right? Sorry, this is 50. Then this is 25. Make the correction here. 25 should be shared in the ratio of 5:2. 15,000 for A, 10,000 for B. Am I right? Now, what is the ultimate value? I don't want this anymore. I have posted all the required items from the balance sheet. Now, I am going to close the books of accounts. Yes. Find out the balance. 1,95,000. 1,30,000. These two are loss. This is 1,30,000. 57,500. 87,500. 57,500. Now, goodwill to be adjusted here. 1,000 debit, 2,500 debit, 3,500 credit. Now find out the balance after the adjustment. 1,95,000 minus 1,000, 1,94,000 is the capital of A. For B, you have to do summation of all the three values. 2,15,000. For C, 43,000. Sorry, 61,000. This is plus value, 3,500. 61,000. Adjusted capital. So their capital ratio being 4:5:1, right? Keeping B's capital as a base, we have to adjust the other partner's capital. 4:5:1. 2,15,000 is for 5 share. And 1 share should be 43,000. 4 shares should be 1,72,000. So we have adjusted the capital required for all the three partners, keeping B's capital being base 172, 215, 43. A has capital excess by 22,000 can be transferable to the current account. Current account credit. Here also we have excess, so 18,000 rupees current account credit. If there is a shortage, we can show this being the debit. Here we have the excess only, so credit. So A's capital being 1,72,000. B's capital being 2,15,000. C's capital being 43,000. Current account. Under that, A and C. A being 22,000. C being 18,000. That's all. So short. If you prepare the capital account, you will get the same. But of course, the capital account not required, as well as realization account not required. No need to pass the journal entry. You are asked to give the treatment for the goodwill, and directly you are requested to prepare the balance sheet. We prepare the balance sheet. The final thing is we need to know what is the capital balance that we have for these three partners. Only because of that we need to do this working note. If you tally the balance sheet, hope it will be agreeing with 6,45,000. 6,45,000. In Singar Academy text, I solved using the realization account model also. I opened the realization account and the partner's capital account and all for your better understanding. Of course, not required for this question.
You have received 500 rupees on payment.
Clear? Shall I move on to the next one? Text me. Let's now move on to the next one. Conversion of partnership firm into company. So partnership firm is converted into company. Otherwise, assets and liabilities of partnership firm is taken over by the company. X and Y carrying on business or partnership sharing profits and losses equally. Wish to dissolve the firm and sell the business to newly formed X Limited company. When the firm's position was as follows. Balance sheet is there. And these are the additional informations also be given. The arrangements with X Limited was as follows. Land and building was purchased at 20% more than the book value. Furniture and stock were purchased at book values less 15%. less 15%. Okay. The goodwill of the firm was valued at rupees 40. The partners are sharing profits and losses equal. The firm's debtors, cash and creditors were not to be taken over, but the company agreed to collect the book debts of the firm and discharge the creditors of the firm as an agent, for which services the company was to be paid 5% on all collections from firm's debtors and 3% on cash payment to firm's creditors. So debtors, cash and creditors not taken over, but the entity company, purchasing company, acts an agent to collect the amount from the debtors and pay off the creditors. Pay off the creditors. And for that, for collection, it costs us a higher work. So 5% commission is demanded for payment to the creditors after negotiation. They have to claim the discount and settle. No, so demanded 3% commission. So for debtors 5% commission, for creditors 3% commission demanded by the purchasing entity. The purchase price was to be discharged by the company in fully paid equity shares of rupees 10 each at rupees 12 rupees per share, means at a premium of rupees 12. Purchase consideration paid all the amounts from debtors. The creditors were paid off less 1,000 allowed by them as discount, and the company paid the balance due to the vendors in cash. Right. So here discount is claimed, 1,000 discount is claimed. And prepare realization account, capital account, partners capital account and cash account in the books of partnership. Simple illustration. Simple illustration. Come on. You finish off calculating the purchase consideration and close the books of accounts. That's all. So normal dissolution like. You are going to close the books of accounts. And purchase consideration account. What are the accounts supposed to open? Realization account, capital account and cash account only. Realization account, capital account and then cash account. Even purchase consideration account as well as purchasing company. Okay, X limited, right? X limited company is also not required to be open. And of course, you have to open cash account also. Cash account. So we have two partners here, X and Y, sharing profits and losses equally. Record the balance sheet items. So land and building, 1 lakh. Furniture, 40,000. Stock, 1 lakh. Debtors, 66. Cash not taken over. Cash not taken over, so balance here. And capital account, X 1,50,000, Y 1 lakh. Sundry creditors 60. Okay. Now we'll find out the purchase consideration. Land and building 1 lakh 20% higher value is given 120. Furniture 40 minus 15, 6,000 should be subtracted, so 34,000. Stock 1 lakh minus 15, 85,000. What is the purchase consideration here? 2 lakhs 79,000. Payable by way of equity share capital. Come on, tell me number of equity shares. You have to divide this by 12. How many number of equity shares are issued? 20? 2 lakhs? Okay, goodwill. Here is 40,000 rupees. What is the number of shares? 23,000? 50. 250. 23,250. Apart from that, debtors and creditors, this value is offered for what? These three items. Payable by way of equity share capital and securities premium. 2,79,000 by X Limited. Okay, this can be transferable to the capital account here. Equity share capital and securities premium. You can share there in P&L ratio 1:1. If you share in their P&L ratio, how much will you get for X as well as Y? 1 lakh 39,500 for X, 1,39,500 is for Y. In this case, we have multiple assumptions. The purchase consideration 2,79,000 is offered to XY. No, can be offered to these two based on their own P&L ratio or final claim ratio. What is the final amount payable to X and Y? You finish up that. Using that also you can share. I solved in the text using the final claim ratio, but I am going to solve here using the P&L ratio. So as they are enjoying equal rights, in the company also they want to enjoy the equal right, means they need to have the share capital equally. Unless specifically stated in the question, it's your assumption. Final claim ratio or in their P&L ratio. I use the P&L ratio here. The other way you can use the capital ratio also. 1 lakh 50, 1 lakh. 15:10, otherwise 3:2. That ratio also be followed. As the distribution of the purchase consideration between these two partners is silent, it's your choice. You can use the P&L ratio or capital ratio or final claim ratio. Now, see here. Debtors realized fully. How much? 66,000. Creditors paid. How much? 59,000. 1,000 rupees discount we received. We have, means this one is done by X Limited as a caretaker for this entity. 7,000 rupees is payable, no, but they demand commission. Commission on debtors, how much? 5%. So 66,000 into 5%. 3,300. And similarly, he demands a commission for creditors settlement also for 59,000. 3% he demands. 770. So the total commission being 5,070. From 7,000, 5,070 is subtracted. 1,930 is the final amount paid by X Limited to firm. Okay. For the debtors and creditors, finally settlement being bank or cash, the value being 1930. Transfer here 1930. Realization. For net of debtors, creditors, we got this money. We got this money. Now, close the realization account to find out the profit and loss. Hope you'll be getting profit. So 3,40,930. 3,40,930. Here, capital. Profit shared between X and Y. 34,930 profit, I think so, right? Shared between X and Y equally. 17,465. 17,465. Transfer that to the capital account. Here, realization profit. 17,465. 17,465. Finish off tallying and find out if there is any balance, either cash payable or cash recoverable. For X, 1,67,465, but only 1,39,500 is allotted. 27,965 will be the cash settled to X. 965. Similarly, for Y, you have to reverse it. Ask him to bring further. Earlier, he had only 1 lakh, but in the company, he gets 1,39,000. So he has to bring additional cash into business. How much is that? 22,000? 035. Okay. 22,035. This is Y's capital. Hope if you tally, then it will be agreeing. Cross verify. In the text, I have used the final settlement. Final settlement is nothing but you tally here. You tally here. X will have 1,67,465. Y will have 1,17,465. We use this ratio to distribute this 2,79,000. That model is followed in the Singar Academy's text. Is that okay? This 2,79,000 should be distributed in this ratio. Final settlement. What is the amount you supposed to pay to them? Okay. In that ratio to segregate the capital. Clear? Text me. Online students, come on, respond me. Now we'll move on to the next illustration. Again, sale to a company or conversion into company. It is also similar to the earlier illustration. One uniqueness is here. A and B were carrying on business as equal partners. The firm's balance sheet as on 31st December 23 was as follows. The business was carried on till 30th June 2024. After this, another 6 months, 30th June, was carried on as a partnership firm only. Okay, up to this. On 30th June 24, the firm sold the business to a limited company for rupees 4 lakhs payable in equity shares of rupees 10 each. After this only, the sale happens, then the purchase consideration being 4 lakhs, which is the lump sum method consideration. The partners decided to take shares in the profit sharing ratio. This one is shared by the partners in their own P&L ratio itself. Equal partners. So this will be shared by these two partners equally. Any difference should be settled in the form of cash. You are now required to prepare the net statement, net assets as on 30th June 2024. As already you run the business for 6 months, you know you need to find out what is the balance sheet at the time of sale into the company. And also prepare statement of profit earned during the period of 6 months ended this date. You have to do these two first of all. Otherwise, you have to prepare the balance sheet as on the date of sale. Thereafter, you can prepare realization account and capital account to close the books. First half year, the transaction details is here. Let's see. The partners withdrew in equal amounts of half the amount of profits made during the period of 6 months. Okay. Let me carry on this one after one. Okay. I'll keep this balance sheet here. Okay. The partners are sharing profits and losses equally. Now, equal share. And firm's total capital. What is their opening capital they have in the year beginning? 1,38,000, 1,52,000. Firm's total capital be 2,90,000 rupees. The business was carried on till 30th June 2024. The partners withdrew an equal amounts, half the amount of profits made during the period of 6 months. From January to this period after charging depreciation on this one. These are the details for the depreciation. Leasehold assets 10% per annum, but it is only for 6 months, so you have to calculate for 5%. Now 5% depreciation being 4,000, then it becomes 76,000. Plant and machinery also 5%, 9,000. If I subtract, then the value being 1,71,000. Furniture 5%, 1,000, then it is 19,000. So we got the revised balance sheet details. Right. The main statement that you have to understand here is all about they withdraw half of their profit. So add profit, subtract drawings. The ultimate value what they have here is nothing but closing capital. Closing capital means 6-month end capital. If the profit being 2 rupees, drawing should be 1 rupee. Is that okay? So the partners withdrew equal amounts, half the amount of profit. If they made a profit of 1 lakh, A and B share the profits equally, 50-50. In that, half of the amount, 25-25 is drawn. Okay, that's how you can remember here. I am not aware about their capital at the year end. Now, another 3 more points are left. Another 3 more points. Meanwhile, sundry creditors were reduced by 15,000. So now new sundry creditors being 55,000. Bills payable also reduced by 2,500, 7,500. Bank loan by 20,000 rupees. Now new bank loan being 20,000 rupees. On 30th June, stock was valued at rupees 70. This stock being 70,000 rupees. And bad debt, book debt being 75,000. And cash and bank balance on the date being 2,500. Okay. This is what about the new balance sheet. New balance sheet. I'll put that new balance sheet here. Yes. Balance sheet at the time of sale. Leasehold building. How much is that? 76,000. Plant and machinery 1,71,000. Furniture 19,000. Stock 70. Debtor 75,000. Bank 25,000. 2,500. Okay. Capital A, B. The latest information is missing, that you have to find out as a missing data. Bank loan 20 and creditors 55,000. Bills payable 7,500. Find out the total and find out the capital of the partners. So 4,13,500. 4,13,500. The balancing figure being the capital of the firm. 3,31,000. Now I need to know out of the 3,31,000 how much is for A, how much is for B. Okay. It's not equal. Initial capital is not equal, right? So naturally what happens, I can post that value here. 3,31,000. Find out the difference between these two. This 41,000 is what? 1 share. 2 minus 1, 1 share is equal to 41,000. Means their drawing is 41,000. Their capital profit should be 82,000. Missing data, like you can calculate. As earned 82,000 rupees, their P&L ratio being equal. So 41,000 profit for A and 41,000 profit for B. And in that 50% is drawn. Then ultimate closing capital here being 1 lakh for A, for B 1 lakh 72,500. So we got the value for A, which is 1,58,500, for B 1,72,500. So this calculation can be done only by preparing a small working note here. So now we found out the balance sheet as on the date of conversion. So here conversion is pretty simple, but balance sheet is not given for the conversion date. Earlier date is given, so you need to find out what is the balance sheet as on the date of conversion and then proceed as usual. Now the purchase consideration is very simple, 4 lakhs, lump sum method, and you need to prepare realization and capital account without any problem. You can easily solve this one. Let me try to solve this. So I prepare capital account and then realization account. So realization account and capital account, only these two. Who are the partners? A and B are the partners. Now the illustration is pretty simple. No adjustments for all the assets and liabilities taken over. Only one consideration, 4 lakhs, is payable. That to be shared by these two partners equally as per their P&L ratio. Record the balance sheet items. Assets, I will finish off. Building. Book value and realizable value assumed to be the same. So I post it here. Plant and machinery, 1,71,000. Furniture, 19,000. Stock, 70,000. Debtors, 75,000. Bank, 2,500. In liabilities, bank loan, 20. Creditors, 55,000. Bills payable, 7,500. Capital balance of these two partners as per the revised value, 1,58,500, 1,72,500. The payment will be in the form of equity share capital of the transferee company. This is shared by these two partners in their P&L ratio. On tallying that, if you get any profit or loss, will be shared between A and B in their P&L ratio. 1:1. 4,82,500. 4,82,500. 69,000 should be shared among the two partners, capital A and B. 34,500, 34,500. So here realization account profit, 34,500, 34,500. If there is any shortage and surplus, it should be adjusted by way of bringing or settling the cash. For A, I think he should bring in additional capital of ₹7,000. In case of B, he should be paid off that 7,000 rupees. Okay. 2,07,000 cash. So if you open the cash account, you get the cash from A and you use that cash to pay B. So here the workload is for preparing this one, not here. So with that, all the concepts related to the partnership is over.